Welcome to the debate. Today, we're delving into the Hedera network, which is becoming a really important player in the DLT space, powered by its native cryptocurrency, HBAR.
And it really distinguishes itself sharply from traditional blockchains, mainly through its use of the Hashgraph consensus algorithm and, I think this is the critical part, its governance structure. You have a council of huge recognizable global enterprises, Google, IBM, Boeing, the list goes on.
Exactly. And that positioning frames Hedera as this sort of third-generation DLT. It's focused squarely on enterprise-grade stability and the massive potential of real-world asset tokenization, or RWA. But, that unique architecture creates a tension, and that tension is really central to its viability as an investment. Institutional focus. Is it a fundamentally sound long-term investment that's poised for major growth?
Or does its current market performance and, frankly, its centralized-leaning governance model introduce a prohibitive amount of risk and maybe limit its potential?
And I'll be arguing that HBAR is a uniquely positioned, high-potential investment. I think it's established a deep, defensible moat that's based on regulatory clarity and core utility that its competitors, they just can't match it.
And I come at it from a different angle. While the technology is certainly remarkable, and I don't think anyone's debating that, the highly optimistic view ignores the harsh market reality. I think HBAR faces some significant challenges from established competitors, from market volatility, and that means its long-term success is far from guaranteed. The infrastructure is premium for sure, but the investment profile is speculative.
So I stand by what I call the institutional infrastructure thesis. For anyone looking for long-term exposure in this space, HBAR represents a necessary hold precisely because it has built a superior, audited, and compliant foundation for enterprise use that no other competitor has really managed to replicate.
Okay.
Let's just start with the technical superiority. We are talking about achieving asynchronous Byzantine fault tolerance, or aBFT. This isn't just about being fast. It's the highest possible degree of security a consensus algorithm can provide. People often call it the holy grail of distributed computing. Hashgraph doesn't just process transactions quickly, it achieves deterministic finality in, about 3 to 5 seconds?
And why is that specific speed so critical?
Well, when you're tokenizing regulated assets, like a multi-million-dollar bond or commercial real estate, you simply cannot afford uncertainty. And critically, the Hashgraph algorithm makes forking, which is a common problem in traditional blockchain, mathematically impossible. This is a non-negotiable requirement for regulated high-value RWA adoption. But the real moat, I think, lies in the regulatory clarity, especially here in the United States. HBAR has been classified as a non-security by the SEC. This provides an almost unprecedented advantage for institutional adoption. You have Bloomberg analysts citing this clarity as giving a 90% likelihood of an HBAR ETF approval. So when you consider the major traditional finance players, BlackRock, Fidelity, already running regulated money market funds on the network, and the fact that we've seen over $5 billion in commercial real estate tokenized live on Hedera, you see utility attracting real institutional capital because of that compliance-first approach.
I recognize the power of that regulatory clarity. I do. But I think that highly optimistic, enterprise-focused view completely misreads the market reality. The investment potential of HBAR isn't just dictated by its technical specs or even its governing council. It's dictated by market performance and, competition.
But the partnerships are there.
The partnerships are there, but despite all the incredible names you cite, Google, IBM, all that institutional adoption, HBAR has maintained strikingly modest and volatile price action. It trades substantially below its all-time high of nearly 45 cents. Even as we look into early 2026, it's hovering around that 12-cent zone. And yeah, you can find forecasts that project astronomical growth. Some even suggest $100 by 2030. But there are equally credible pessimistic forecasts suggesting it may stay stuck far lower in the sub-3-cent range for the next few years. That deep lack of consensus on its immediate present value, it suggests the price is being driven more by technical speculation and hype than by the realized, sustained utility you claim is flowing from those partnerships.
And moreover, while Hedera has successfully cornered this
enterprise trust niche, rival ecosystems have definitively won the capital efficiency war for liquidity and immediate throughput. I mean, just look at the raw metrics. In 2025, a competing ecosystem like Solana was processing over $11.7 trillion in stablecoin transfers and generating $2.39 billion in app revenue. Let's just pause on that number for a moment. 11.7 trillion? That scale demonstrates deep retail and institutional liquidity and velocity. That's essential for bootstrapping new applications and protocols. Hedera has to compete against that massive entrenched liquidity if it expects its technical superiority to translate into significant HBAR value appreciation.
Okay, but all that security and stability you're selling, that brings us right back to the governance question, doesn't it? I'm not convinced that the trade-off for stability is worth the potential for centralization risk.
Right.
The Hedera model is a public network, but it runs on permissioned nodes exclusively managed by the council. And crucially, Swirlds Inc., the company that invented the Hashgraph technology, retains a permanent seat on that council. Stakeholders and, a lot of developers in the Web3 native community, they worry that this structure, which is clearly designed for corporate predictability and legal accountability, fundamentally limits genuine community decentralization. It's governance by committee, which it might stifle the very kind of agile, rapid, and broad community adoption you need for long-term value appreciation.
I see why you think that, but let me give you a different perspective. That predictability isn't a trade-off. It is the fundamental point. It is a necessary feature for regulated assets and global enterprises.
So it's a feature, not a bug.
Exactly. Think about the structure. The council is designed for diversity, specifically mapped across major economic sectors, GICS sectors, and geography, with equal voting rights. This design is explicitly resistant to collusion. If you are Boeing or Google or Nomura, and you're planning to tokenize a billion-dollar supply chain or issue a bond, you need certainty that the governance framework won't suddenly be hijacked by a volatile token-weighted majority. The council provides the stability and accountability that regulated companies demand. It's what gives them the assurance that the network won't fork and that the fixed, low-cost fees, currently locked in at just 1/10 of a cent per transaction, will remain stable for business planning over a decade. This governance structure is the regulatory mode. It attracts institutional capital that just cannot accept the risks inherent in anonymous, highly volatile, fully decentralized systems.
But can we truly call it a moat if the price doesn't reflect the capital pouring through it? Let's pivot back to utility, since that's the foundation of your whole thesis.
Let's do it.
You argue that the HBAR token's utility is non-speculative, that it's tied directly to network consumption, it's the fuel for transactions, smart contracts, staking rewards, and you mentioned the tokenomics are favorable because 85, almost 86% of the 50 billion fixed supply is already in circulation, which reduces future sell pressure from big scheduled unlocks.
Right, and beyond that, the data on capital inflows seems pretty unambiguous. USDC liquidity on Hedera surged an impressive 63% between mid-December 2025 and early January 2026. This isn't just retail hype. This is a massive influx of real, compliant capital moving onto the chain, signaling true utility demand from institutional players preparing for the 2026 market cycle and beyond. This is money that requires stability.
That's a compelling argument, but I'm sorry, I just don't buy that the current muted price action truly reflects that utility demand. If the demand were truly overwhelming and utility-driven, HBAR wouldn't be struggling to break key technical resistance levels that have plagued it for years. Yes, a 63% surge in USDC liquidity is great, but we have to ask, is that capital being used for high-velocity, utility-driven consumption driving up transaction fees, or is it just anchor capital parking funds on a regulated platform waiting for the ecosystem to actually materialize? Because if it were the former, the price would be moving decisively. The token's success relies entirely on this ambitious, optimistic scenario that it reaches price points like 50 or 75 cents by 2030, and that requires success against platforms that already command trillions in stablecoin volume. I mean, current analysis indicates HBAR still needs to maintain critical technical support around 12 cents and then break major resistance at 16 cents just to confirm short-term bullish momentum for the first quarter of 2026. The fact that its price remains so highly influenced by technical trading signals rather than being driven solely by realized utility suggests its investment profile is still highly speculative, regardless of the underlying tech.
I agree that the price is a reflection of current market speculation, but that it is simply the lag between enterprise utility and retail price discovery. The utility is foundational, and I would argue guaranteed by the council's commitments. We are seeing that utility through massive RWA deals and institutional adoption. What we're seeing in the price is just the market waiting for the final pieces of the architecture to fall into place, which I think leads directly to the execution risk that you mentioned.
The reliance on future technical milestones is a huge liability. Hedera's path to greater decentralization is still heavily tied to a technical roadmap that demands mandatory, non-negotiable upgrades. We're talking about the introduction of block nodes and block streams.
Right.
For our listeners who might not be running a full enterprise node, the community and developers, they rely on mirror nodes to consume and verify the network data. Right now, that data is often pulled from centralized cloud storage buckets, which is costly, slow, and yes, centralized. The block node and block stream rollout is necessary to decentralize that data layer. However, this isn't an optional adoption. Mirror node operators must upgrade to the minimum required version, v0.148-0, by May 2026. Ahead of the full June consensus upgrade. Failure to execute this mandatory switch will result in data ingestion failure. It means those community nodes simply stop working. This dependence on the core development team for critical, timely, mandatory upgrades. It highlights that the network's function is still reliant on central coordination rather than fully autonomous, community-driven operation. The risk of a delay or non-compliance is it's existential for the data layer.
That's a compelling argument regarding the logistical challenge, but have you considered that this planned rollout demonstrates a clear, executable, and compliant path towards decentralization, which is exactly what institutions require? The block node and block stream transition is essential, precisely because it eliminates the cost and maintenance burden of centralized cloud storage for data consumption. It shifts the burden of data hosting and verification onto the community, fulfilling that long-term vision of a network governed by enterprises but run by the community. It moves the entire data ecosystem away from expensive, proprietary, central points of failure. More importantly, this planned infrastructure upgrade is the key to unlocking future services that institutional players need. It enables state proofs, cryptographically verifiable proofs of the network state, which are absolutely critical for auditability and institutional trust in a regulated environment. The network is using this infrastructure to actively develop verifiable AI applications, like the AI Studio expansion planned for 2026, which will anchor high-value AI training data and decisions to the ledger. Hedera is building the compliance layer that makes massive enterprise AI adoption possible, and the technical roadmap you cite as a risk is actually the necessary path to achieve that final step of compliant, auditable, decentralized infrastructure.
I recognize the roadmap is necessary for their long-term vision, but the fact remains that a failure of execution in the first half of 2026 will halt the momentum you're celebrating. The market is not forgiving of delays, and every week that passes is another week where competitors are scaling up their liquidity and securing new partnerships.
Let's be blunt. Enterprises need two things: stability and speed and efficiency. Hedera delivers stability in spades, but when it comes to raw capital efficiency, velocity, and the sheer volume of stablecoin flows that dictate where new DeFi applications launch, they are fighting an uphill battle against ecosystems with an order of magnitude more retail and institutional money already on the rails. That competition remains HBAR's single greatest investment hurdle. See, I think you're fundamentally misunderstanding the target market. Hedera isn't trying to capture the retail DeFi speculator. It is targeting the digitization of global assets, a market that dwarfs the current DeFi ecosystem. It doesn't need trillions in high-velocity stablecoin flow today. It needs the compliant infrastructure to manage the $500 trillion global RWA market tomorrow. The fact that the governance ensures fixed, low-cost fees is the core reason enterprises choose it over competitors with volatile gas markets. The stability and predictability is the superior value proposition for the RWA market.
So in summary, I believe HBAR's investment case is robust and foundational. It possesses best-in-class security via adapt, deterministic speed, and an unmatched institutional regulatory moat, which is solidified by its non-security classification here in the U.S. That smooths the path from major financial players. And while the current market cap may not yet fully reflect its utility, a reflection we have seen in that dramatic rise in USDC liquidity, the token is perfectly positioned as the infrastructure layer for the digitization of global assets. This shift is already happening on the network with major ROWA tokenization successes, and the imminent HBAR ETF filings provide a regulated path for traditional financial institutions to gain compliant exposure.
Investors must, however, proceed with extreme caution. HBAR's technological advantage is, I think we both agree, undisputed, but its investment profile is currently defined by volatility and intense competitive pressure from rivals that have captured trillions in stablecoin volume and possess significantly greater retail and institutional liquidity today. The long-term success of HBAR hinges entirely on two factors: the flawless, timely execution of its crucial 2026 technical roadmap, specifically that mandatory block node migration, and the ability of its enterprise partnerships to generate utility-driven demand that's massive enough to overcome years of market consolidation and successfully challenge the established ecosystems winning the volume war.
The merits of HBAR as an investment must therefore be weighed by assessing that delicate balance between its superior regulatory compliance enterprise technology and the highly competitive and volatile market landscape it operates within.
Right. The question really is whether that enterprise gravity will eventually overcome market inertia.